Welcome to The Explainer. We're going to get right into it today and talk about the math of risk. How do banks actually figure out how much money they could lose on any given loan? Let's break it down.
Right, so this is a huge question. Think about it. When a bank is lending, millions, sometimes billions of dollars, they're not just crossing their fingers and hoping for the best. No way. There's a real calculated science they use to try and peek into the future.
And their secret weapon? It's a powerful little tool called the expected loss formula. This is the key equation they use to predict and, crucially, to put a real number on their potential losses for any loan they make.
All right, so let's talk about the lender's equation. This formula is basically a roadmap for this whole explainer. It's how they turn that fuzzy feeling of risk into a cold, hard number. Let's get it up on the screen.
Okay, here it is. Expected loss equals probability of default times loss given default times exposure at default. Now, I know, it looks kind of complicated, maybe a little intimidating, but trust me, it's not. It's really just three pieces. Think of it like this. What's the chance someone won't pay us back? If they don't, how much will we actually lose? And how much money do we have on the line in the first place? That's it. We're going to tackle each of these one by one. So first things first, we're talking about the probability of default. But hold on, what even is a default? Before we can figure out the odds of it happening, we gotta be super clear on what it is.
So what does it really mean for a company to be in default? Well, you might think it's just about missing a payment, right? But it's actually way more than that. The real answer is buried in the nitty-gritty, the fine print of those loan documents.
Okay, so here's the classic definition, the one everyone knows: not paying your principal or interest when it's due. A payment date comes, the money doesn't show up. Seems straightforward. But, in the real world of finance, that's just the tip of the iceberg. And this is where it gets really interesting. A company can be making every single payment on time, like clockwork, and still be in default. How? Well, maybe they breached what's called a financial covenant, like they agreed to keep a certain amount of cash in the bank, and they let it dip below that line. Boom, that's a default. Or maybe a cross default gets triggered. Yeah, a cross default is a huge one. It's basically a clause that says, hey, if you default with somebody else, then you're automatically in default with me too. It's like a financial tripwire. If you stumble with one lender, it sets off alarms for all of them. It's a domino effect, and it's all designed to protect every single person who's lent that company money.
All right, so now we know what a default can look like. It's pretty complex, right? So let's get back to our main equation and start calculating the probability of any of that stuff happening. So, back to the formula. We're zeroing in on that first piece, the probability of default, or PD as they call it in the biz. And this is where the lenders really put on their detective hats. They're gathering clues, looking for evidence, all to try and predict the future. So how do they actually determine this PD? They can't just guess, right? Feels like a 5% chance. No, it's a mix of super deep analysis and looking at tons and tons of historical data to land on that one critical number. And when I say they look at everything, I mean everything. They're digging through the company's financials, checking out their credit rating from the big agencies like Moody's or S&P. They're even looking back in time at historical data to see, how often have companies like this one defaulted before. It's this whole mashup of hard data from the past and trying to forecast what's coming next. Okay, so calculating the probability of a default happening, that's one piece of the puzzle. But what's the next question you'd ask? Well, it's pretty obvious. If it does happen, how bad is it going to be? How much money are we actually going to lose? And that brings us right to the second part of our equation, loss given default, or LGD. This is the number that puts a figure on the financial pain. It's the percentage of the loan that the lender expects will just disappear, gone for good. So after a default, what's the actual loss going to be? Well, to figure that out, the lender has to ask, okay, what can we realistically get back? After all the bankruptcy filings, the liquidations, the messy negotiations, what's left? And that amount they expect to get back is called the recovery rate. And calculating the LGD from there, it's actually super simple. The loss is just everything you didn't recover. So it's 100% minus that recovery rate. Let's make this real with a quick example. Imagine a lender looks at a bunch of old data and figures, okay, for this kind of loan, we usually get back about 40 cents for every dollar we lent out. So their recovery rate is 40%. So if they get 40% back,
What's the loss? You got it. It's the other 60%. That's their loss given default. Simple as that. It's the chunk of the loan they're pretty much expecting to kiss goodbye.
And this is so important to understand. Not all debt is created equal. The potential loss changes massively depending on these factors. I mean, is the loan backed by something solid, like a building? That's collateral. Is it a senior loan, meaning you're first in line to get paid back if things go south? Or are you at the back of the line? All of this stuff dramatically changes that recovery rate and, by extension, the LGD.
Okay, let's take a quick breath. We've talked about the chance of a default happening and the percentage we'd lose if it does. So what's left? Let's bring the last piece of the puzzle into focus and finish this thing. All right, so here's our full formula again. Expected loss equals probability of default times loss given default times the last piece, exposure at default. And what's that? It's just the total amount of money the lender could possibly lose at the moment of default. So for a basic loan, it's just what's left to be paid. But think about a credit line. It's also any money the borrower could draw down right before they go bust. So you take the chance it'll happen, times the percentage you'll lose, times the total amount you have on the line, and bam, that's it. That's the expected loss. It takes that vague, nervous feeling of risk and turns it into a hard dollar amount that the bank can actually plan around. So, now that you know the formula, think about how this changes the way you see financial news. Because this isn't just some dusty formula in a textbook. No way. This three-part equation is the quiet engine running behind the scenes, driving huge decisions about who gets loans, what gets invested in, pretty much the health of the whole economy. The next time you hear on the news that a company's credit rating got downgraded, now you know what that really means. It means their probability of default just ticked up, and that changes the entire risk calculation for everybody involved.